Hello, good morning, good afternoon, good evening, wherever you are, for my local and participants from across the world. Welcome to another edition of Business and Banking Dialogue. This, as you know, is a channel is now available on the EPS channel as well as the YouTube, Twitter, Facebook, and LinkedIn. I'm KK, your host for today's Business and Banking Dialogue show. Our topic of discussion is very interesting. What is the real agenda of banking reforms? To discuss on this topic, we have with us none other than the widely read and experienced banker, author, public speaker, and digital leader, Mr. Mrutyunjay Mahapatra. He has earlier come to our shows, and you know how it was very informative and thought-provoking. Till recently, he was CEO of a large PSU bank and is credited with all-round transformation of the bank. Member of Insurance Advisory Council of India. In the past, he headed global strategy, payments, transactions, and transformation programs of SBI as its head of strategy and chief digital officer. I had the fortune of being with him for some time when he was with SBI. He was also the CIO of the bank, and he has been a leader in many transformation initiatives in the State Bank of India. Ladies and gentlemen, keep your pen and paper ready to note some of the books that he suggests and recommends. Last time, if you remember, he recommended Banks 4.0 and Digital Nation by Chandra. Amazing books to read. If you haven't ordered for it, please order and read those books. So today we will hear from him much more. Good afternoon, Mr. Mahapatra.
Good afternoon.
Yeah, look forward to talking to you, sir, as usual. To a highly informative and thought-provoking session with you, sir. Ladies and gentlemen, India's banking sector supports one of the fastest growing large economies in the world. That's India. However, the sector is grappling with a set of new realities that are testing its strength and resilience. You have heard about the NPA problems. You had speakers in this dialogue telling you about the NPA problems, which are pretty huge. COVID is another big factor that has hit us not only in India but across the globe. But you know, it's a big problem for us. Low credit demand from industries and dragging down performance and threatening future growth. Urgent attention is required to ensure that the sector can continue to be a key driver of the Indian economy. Extremely important. Real sweeping reforms are required to take Indian banking to a brave new world, as I would put it, to tell you the magnanimity of the problem and how the banking industry is at the fulcrum of our economy. So if I have to highlight some of the big ticket measures that happened in BC, I don't mean before Christ, I mean before COVID, were, I would just put some of them. 10 public sector banks merged into 4. RBI reduced the lending rates. Aadhaar and PAN card authentication mandatory to fill ITR. Banking reforms becoming easier with digital options. A lot of digital transformation taking place. Revised ATM mechanism, cheaper and safer transaction. So, are these real banking reforms or mere corrections to make banking operations efficient? Your thoughts?
Thank you, KK, for having me once again. I think when we speak of reforms, reform is often confused, like whatever you told, yes. Whether improvement around the edges is a reform or reform has a transformational connotation. I think it must have a transformational connotation because, as they say, if a company and an industry has to grow at the rate of inflation, we do not need managers or we do not need senior management. I think it will grow by itself or it will degrow by itself. Yeah. So, when we are speaking of banking sector reforms, we can put them into 2 or 3 large headlines. Mm-hmm. One is reforms or improvements that that must come, even if there is nothing like COVID or there is nothing like the challenges that we are facing today in the Indian banking sector or the global banking sector. In fact, going forward, we will try to put it in context.
Yeah.
That why banking reform has hogged the headline all the time, for the last 100 years. In India, if you look at it, the first banking sector reform was probably creation of State Bank of India and creation of Reserve Bank of India. Before that, separation of the regulatory functions or the currency issuing functions from the commercial banking functions were the first steps that the administration and the policymakers had to take to put banking into context. So, to answer to your question, I think technological upgradation is maybe at best it can be put as a survival reform.
Yes.
At worst, probably it would have happened, irrespective of whether we speak of banking sector challenge or whatever, because when the first Narasimhan Committee report came in 1991, I remember I was not even 30 at that time. So when in informal banking sectors, we started speaking about banking sector reforms. And during that time, State Bank of India was given a maximum remaining life of 10 years. That so many private sector banks will come and there'll be so much of transparency. So I believe that organizations, enterprises, and companies in general keep on doing upgradation to their governance, to their technology, to their people methods, to their market connection. So some of the things that we are looking today are posed by the ecosystem, posed by the millennial generation, and posed by what is required to stay relevant. Some, of course, if we look at in the public sector banking kind of an atmosphere, probably the reform has worked as a catalyst or as an accelerator for getting these on board, up and running faster than as usual.
Yeah. Okay, sir. So that kind of sets the perspective on it. So some of these measures could be called as real reforms. Some are more as efficiency, but we very, very loosely use the word banking reforms for almost everything that comes out. And that, I think, something we should be careful about. So let's look at another announcement. On 26th of February 2020, the Finance Minister unveiled EASE, Enhanced Access and Service Excellence 3.0. So the public sector reforms agenda 2021 for smart and tech-enabled banking. So it was more to enhance the technology adoption. Can you explain, and will EASE put the banking sector on a transformational path?
This is, I think, this goes back, as I told you, this is partly a repackaging of what was being done. Because if you look back at the Rangarajan Committee report, where computerization, negotiating with the unions, because the unions were the major roadblock in computerization because they feared job loss.
Yes.
So that was not happening. And before that, even Narasimhan Committee 2 and PJ Nayak Committee, all those were instrumental in giving that impetus to the banking sector in India. Yeah. And of course, the crisis of 2008, the Dodd-Frank Act, and the formation of the Basel regulations, all those kind of did their bit in bringing together a framework for reforms. Of course, when we go forward, we will discuss the literature availability in the banking sector reform is limited to people who have been central bankers or who have been bureaucrats.
Yeah.
So to that extent, because probably the commercial bankers are not very comfortable in writing, so we do not have published books and literature on what should be the dimensions of public sector banking or banking sector reforms. There are some books which have been published. I will discuss some of them, as you rightly told, because I believe that my knowledge based on my own experience and my own interaction with the central bankers as well as bureaucrats and my own analysis and interpretation may not be enough. So I have referred to large number of books, but as I told you, one deficiency that is there in published literature, whether it is in academia or whether it is in the form of published books, is that most of the opinion on banking sector reforms has been given by previous governors, previous economic affairs secretaries, previous chief economic advisors, and so on and so forth. So we will try, and I will try to infuse a sense of practicality that why at all we are going on either relaunching these things, or we are repackaging, renaming, and kind of appealing. But coming back for your viewers, just to understand, in 2016-17,
yeah,
when some of the large incidents of default started happening, and some of the defaulters have exhibited a criminal tendency of defrauding or playing around law. During that time, this ease, what is now called ease, is enhanced access and service excellence, was initially launched as Indradhanush.
Okay.
And this Indradhanush program later on was repackaged, and with the help of the global consulting firm that was advising IBA and the Ministry of Finance, this was launched as EASE. So EASE 1.0 and EASE 2.0, now what Finance Minister has announced is EASE 3.0. So EASE 1.0 and EASE 2.0 were essentially cleanup kind of exercises. And if we look at EASE 1.0 and EASE 2.0, just to put it in perspective, initially what happened, as I told you, was that there were large number of, they say, unrecognized NPAs in the system.
Right.
And so unrecognized NPA has two dimensions. And as Arvind Subramanian very aptly calls it, it is called twin balance sheet problem. And for those of your viewers who are not familiar with this twin balance sheet, I think I will give you a little explanation.
Yeah.
Twin balance sheet, like twins, they reflect one another. See, corporates, when they over leverage themselves, they borrow at a capability thinking that the economy will do well perpetually. So when their rate of return comes below the rate of interest that they are paying, in that case, they will not be able to service the loans. And if they are not able to service the loan, the problem in their balance sheets will immediately get reflected in the balance sheet of the banks. Yeah. The stress that is there in the corporate balance sheet will immediately get transmitted into the balance sheet of the banks, and this will get reflected in the financial health of the country. So this is why, this word was coined, which is called twin balance sheet. And under addressing the twin balance sheet requires recognition. And recognition meaning, again, as we say, that it will require recapitalization of banks. And this recapitalization means money. So in 2017, under EASE 1.0, the first step that was taken was that 2.11 lakh crores was first infused into public sector banks as recapitalization. Earlier, earlier recapitalization, if again, some of your viewers are familiar, they will remember that after every recapitalization, government used to sign with the MD and CEO, then called CMDs, some kind of an MOU, which is fairly common across the world, even when the TARP program was launched in the United States or the Swiss banks were bailed out by the government money. It is quite common that even when IMF bails us out, it brings in certain amount of reforms or certain amount of governance changes.
Yeah.
So there are 5 or 6 areas in which government wanted that there should be reforms so that this 2.11 lakh crore of recapitalization money is not money down the drain. The first one, of course, was the governance reform, which meant that the organizational structure needed a review, the appointment of senior executives need a review, and the second one was prudential lending. Mm-hmm. Whether lending was getting influenced, because this was the time when there was a transition of power from the earlier UPA government to the NDA government. So there was some political flavor of the step, but the fact remained that prudential lending, because they were not based on exact algorithms. In when we do bigger loans, there is hardly any formula that can be adopted. But in general, there should be prudential lending. Third was the risk management. Risk management was mostly commonsensical, and risk management was thought that if our intentions are right, things will become right. Whereas globally, risk management has become very mathematical, very model-oriented, data-oriented, warning signal-oriented, and compliance and operation as risk parameters must be onboarded. Now, technology and data-driven banking, what we were seeing in Europe and US, or for that matter, some of the smaller countries like Singapore or Hong Kong, were also guidances to the policymakers to bring as EASE 1.0 and EASE 2.0 these kind of reforms. So EASE 1.0 and EASE 2.0 were both cleanup and foundation laying kind of activities. And EASE 3.0 is taking it towards global banking, global standards, data-driven banking. And EASE 3.0, in fact, has probably 4 or 5 pillars. 4 pillars, I think, lending for aspiring India, where they are telling that millennials want different types of lending. So it must be, there are various steps like dial a loan, there are various steps like, credit at a click, or alternate data-based lending, algorithmic lending, as we call it. There is also, IT moving from productivity-based intervention to a DNA of the banking system. this is the Ease 3.0, which the finance minister told. And the other thing is that, outcome-centric HR. This is easier said than done, because Montek Singh Ahluwalia, in his book, I do not know how many of you have read, this is called Backstage. If some of you want to read it, this is a very good book. And towards the end, that is in page 397, 398, 399, like that, 3-4 pages he has devoted to banking sector reforms.
Mm-hmm.
He says commercial banking is counter-intuitive to government ownership.
Okay.
So governance and outcome-centric HR based on 3 things. When I was doing HR transformation in Syndicate Bank, 3-4 things are required. One is compensation. Second is job content. Third is career growth. How do you combine all these things when everything is put to a defined structure? Because mostly the civil services, because unless job security is there, the political masters will ride roughshod over them. So civil services have the career path has been made very, very regimented. Whereas if you want to do a outcome-centric HR, as is envisaged under Ease 3.0, there are many other reforms that are required. I think we will put the Ease thing for the moment. If and when things come, we will tell.
Sure.
But, banking sector reform, I think, is here to stay, irrespective of political dispensation that is ruling, because it is so ingrained into human life. Banking needs to be reformed as civilization is reforming itself.
Thank you, sir. So, ladies and gentlemen, you've been hearing Mr. Mahapatra, and this subject is on the real agenda of bank reforms. It's a topic that is like many of you would have many questions to ask Mr. Mahapatra, and he's the right gentleman to ask to get your clarity on your questions. So I open up the debate such that you can put your questions in the Q&A box, ask your questions, and I will get it across to Mr. Mahapatra. Or you have also the opportunity of talking to him directly. You can raise a question directly. So you could do that right away. And so I go more into my discussion. So in the recent past, recent years, it's not. I mean, reforms has been going on for years together. I think as and when things were required, the government, the Reserve Bank, they have always been announcing something. You may call it reforms, you may call it some other names, but there's always been something that has come through. So if you look at the recent past that has gone by, there have been a number of reforms have been announced. In your opinion, what has worked and what hasn't? You could name a couple of them as to what they have actually worked well and what has not really worked.
Okay, I think let us see banking sector reforms as part of the overall reform of the country.
Yeah.
So if you look at, let us say, for ease of understanding, 1991, when Dr. Manmohan Singh and P.V. Narasimha Rao started doing reform of not just Indian economy, but I think everything that is associated with the Indian system. Yeah. So what was the aim? That time, the famous acronym that was floated was LPG. Mm-hmm. Liberalization, privatization, and globalization.
Okay. Yeah.
So the banks, if we look at from that liberalization, privatization, and globalization context, reform is meant to making Indian banks internationally competitive, bringing out structural changes so that the resilience of the banks in dealing not only adversarial incidents like the COVID, but also in dealing with new challenges. Like, today I always tell euphemistically is that regulation is the biggest savior of old generation banks, because the entry barriers have been kept at such high level in terms of not just capital, but in terms of manpower, in terms of structure, in terms of compliance, in terms of the other technology requirement, etc. So, but what are these structural changes that are required to be done? The other thing is that, the credit delivery, because again, going back to what the regulation wants, there cannot be a one size fits all.
Yeah.
So Raghuram Rajan, in his new book, which is called Third Pillar, is a very interesting and very insightful book about financial sector and how, and economic history in general. So he writes that, this is the book for those of you who have not read it. I strongly recommend that this book should be read, because it comments on India. It talks about harmonization of regulations across across various geographies, and it says that how World Bank and the Basel Committee are completely on the wrong side when they prescribe similar reforms for developed markets and for developing markets.
True.
So coming to the general banking sector reform, if we look at Narasimhan Committee 1, it started telling that, have greater competition. So newer banks were licensed. Also, they told that, what is the prudential norms. I remember when we were young officers, so nothing like prudential norms. Loans, you keep on recovering, you recognize the full thing, and if the loan cannot be recovered, you write it off. And that was completely a management call.
Yeah.
Now, Narasimhan Committee 2 told that deregulation of branch licensing, that is, you can open branch anywhere you like, you can close any branch, you can shift it to a nearby place, there is no problem, as long as the local authorities are happy about it. And then capital adequacy norms. Diversification of operation, that banks going to insurance as a buffer for income dipping below a particular level and putting them into grief. That was brought during that time. And later on, PJ Naik Committee came, which told that let there be a bank investment company into which the government has to divest all its holding, and let this be listed, and let government be completely away from running of banks. But more and more, as we look into banking, reforms of banking is seemingly very, very and extremely highly interconnected with other sector reforms.
Yeah.
Whether we are looking at, related sector reforms like insurance sector reforms, like mutual fund sector reforms, whether we are looking at legal reforms in which, an insolvency and bankruptcy code will come. How do we, because today public sector banks share has come to 60% of the total banking, private sector bank 25%, but even smaller banks, cooperative banks, and like regional rural banks have significant amount of rural market share. So how do we reform? So these are the questions which must be answered and must be looked at in historical context in order that we take the reform agenda forward. And as you rightly told in the beginning, the various agenda items will keep on varying. But the overall aim should be making Indian banking internationally competitive. They should be able to do credit delivery that is appropriate for a emerging market economy, not for a developed market economy. With developed market economy, people can always, be turned back that yes, no, you are not credit worthy. But when difficulties like this come, let us say MSME sector has to be supported, or agriculture sector has to be supported. The underwriting standards and banking are completely different.
True, absolutely, sir. So I actually have my next query to you is on exactly on that, on this pandemic. Tough times require tough measures have to come in. So the protracted pandemic has been tough on everyone, and on that there's no doubt. And we don't know when this is going to end also. What should be the real agenda of the banking reforms to just navigate this unprecedented crisis? I don't think anybody has thought through about this, and such a thing will come. And it has happened. So what, according to you, are a couple of steps that, according to you, you could suggest that these kind of banking reforms should come up to navigate this crisis?
No, there are, I think we need to put it in 3 or 4 kind of categories.
Right.
Reforms which were impacted because of the COVID, like, for example, the operation of the insolvency and bankruptcy code was kept in abeyance, or payment of GST, or so payment of GST or payment of income tax, if it is deferred, then to that extent data gets skewed. So if the banks are aiming for a reform called algorithmic lending or database lending, because data will get now skewed, so the banks have to realign themselves, redefine their algorithm, and banks have to also find out that minus of these, COVID impacted areas, there are many areas which are showing a V-shaped recovery. In those areas, how the things could be brought back to real better. There are some COVID positive, or what I call that positive because of COVID.
Yeah,
I think the reforms relating to digital banking, reforms related to what we call the HR related work, where you can be more people centric. If today the greatest amount of dissatisfaction in the rank and file of the banking personnel is related to their PESA posting and also the type of work that they are doing.
Yeah.
I think COVID impact has been positive on that. We have found that irrespective of the place of work, a lot of work can be done in a fungible manner. Risk management and measuring the preparedness of the IT system, I think this is this reform which was waiting to take shape. This is likely to be accelerated, and this needs to be accelerated. The investment of money as well as investment of manpower and collaboration, because another reform that we are waiting to unleash is the interconnectedness of the financial system with the technology ecosystem, with the policy-making ecosystem. I think that will get accelerated. Yes, what will be the negative are the increasing NPAs, where it is likely there are varying predictions where between 10 to 12%, if today 12 to 14% is the NPA level in the system, then we may see 2 to 3% rise in the NPA, and this will create more stress on the capital adequacy of the banking system. I think to that extent, efficient use of capital will be one of the bigger requirements. And I hope that going forward, the Reserve Bank of India will also align the capital requirement into various other categories and innovative categories, because as I told, and I agree with Dr. Raghuram Rajan, that it is not that, because if we look going forward, our bank total aggregate bank credit to GDP ratio is just about 1x or 100%. And in China, it is going to around 315, 320%. In UK, it is 500%, and in US, it is about 120, 130%. So as we grow, the credit growth to GDP ratio, because GDP, if it contracts and the credit growth goes up, then there will be new stress that we will see in the banking system. And again, there will be public criticism that banks were doing irresponsible lending. And going forward, I think banks should be prepared to manage credit and operational risk much better than they are doing right now.
So in your view, because of the COVID, there will be going to be another 2 to 3%, as you say, increase in the NPA estimated, right? So recently there was this thought that from IBA actually it came that why not we look at a bad loan bank where all these things are put, so that at least we have then a cleaner bank to deal with. Yeah, your thoughts on that, sir?
Yeah, bad bank. I think I was seeing one of your previous. I think it was Professor Anand or somebody who was mentioning about bad bank. See, bad bank is not entirely. When I was a young officer, that time itself, bad banks were the asset reconstruction companies, ARCs that were formed. They were nothing but bad banks. What has happened was that the performance has been so poor that unless there is a real estate play, the resolution hardly happened. Of course, the legal ecosystem during that period, as a practicing banker, I have seen its evolution. Right from being a young branch manager when it came to becoming a middle-level deputy general manager or a general manager to the level of chief general manager or a deputy managing director or MD and CEO. I have seen that the other reforms have to keep in pace. Otherwise, just creating an entity called a bad bank, which is funded again by the people who are holding these loans, I don't think it makes. And again, I think somebody speaks about a Malaysian example, or somebody speaks about example of some other countries where the upside is shared between people who have sold the assets. I don't think it works. There should be, in my personal view, there should be a clean exit. And to some extent, like what is being done in case of bad loans to MSME sector or something, I think 40 to 50% equity has to be funded by the government, because that is likely to be first loss piece. If, let us say, an asset which in the book of a bank is valued at 100, and if he sells it to a bad bank at 50, the maximum loss that is envisaged is probably 25. So 50% of the equity, it should not be allowed to over leverage itself. What has happened in case of ARCs is that, for buying a 100 rupee loan, 75 or 80 or 85 or 90 or even 95 to begin with, it was 95. Only 5% cash, that is 5% equity. And 95 was issued in the form of SR, which are nothing but debt instruments. So the leverage was 19:1. So an over-leveraged bad bank is the first thing that must be done away with. If we want to do a bad bank, it should be all equity or maximum equity bad bank.
Yeah.
Second is that, there should be various category, like we are doing savings bank accounts, we are having recurring deposit account, we are having this. So it requires a little bit of experienced banking rather than, just bureaucratic and developmental banking. People who have experience both in banking and stress asset resolution have to do this, whatever name we call it a bad bank or a good bank or a angel bank or whatever. So this should be done in a little different way, which is appropriate for our country and based on past experience where we have gone through many cycles of, ARCs, we have gone through BIFR, we have gone through S4A, we have gone through CDR, now we are going through IBC, now we are going through debt recovery tribunals. We have some way of judging these things. I think it should be taken in a systematic and calibrated manner.
Yeah. Thank you. So, so ladies and gentlemen, please send in your queries while I continue to talk. So I have the first query coming your way. It's coming through YouTube. And the question that the gentleman asked, or could be a lady also. So the sale of equity stake of IDBI Bank to LIC, is this a real reform agenda or measure, or it's a simply a rescue act of a distressed bank?
Yeah, I think again I will refer to Arvind Subramaniam, who says that that what was the real reform? Real reform is the biggest bank in the country. When I was heading UK and Europe in London, that time I learned one thing from PRA. PRA asked me to prepare a living will or resolution. What are the high quality liquid assets which will first go into meeting, if there is a meeting the demands of the depositors, if there is a run on the bank. Now what we are seeing is that the system is not allowing, probably it is not yet appropriate for our kind of a situation, for a bank to fail.
Yeah.
Because one of the major requirements for measuring success of any banking sector reform is that if one of your largest banks fail, then whether you are ready to make an orderly failure. But today what is happening is that, leave alone public sector banks, even private sector banks, not even cooperative banks, are allowed to fail.
Yeah.
Because, there are several reasons. I'm not going into argument into that, but failure of the banks. So IDBI Bank's acquisition by LIC, in my personal view, it was not a reform. Okay. It was a rescue act.
Fair enough, sir. That's fine. I have a query. Harish Prabhu is a very experienced banker, very regular participant in this dialogue show. He's there every day. Harish is an experienced banker. He would like to ask a question directly to you. Harish, please unmute and ask the question.
Yeah, good afternoon, sir. See, banking at the end of the day is a microcosm of the economy, and essentially is, serves the economic goals of the country at all times. And this has been actually, seen in China, right? China's growth of banks, was sort of a mirror image of each other. And now obviously it also stressed to the same extent. The other things for enabling or for running a bank, like technology, people, processes, marketplace, etc., they're all dynamic, right? And ever evolving. So my question is, at a very simple level, is that isn't banking reform a continuous process, and isn't it an instrument of policy? So why do we call it that reform at all? It's you have to be agile to serve the marketplace and the needs of the economy, needs of the country, needs of the depositor, needs of the lender, right? So.
Yeah, I think I told right at the beginning that reform is, one is what has to happen. As you told, banking is a continuous process, and as Ron Chernow. Ron Chernow was a famous biographer, and he's a famous author about finance also. He has written many financial biographies. He wrote that in the end of 19th century, two category of people became very, very powerful: doctors and bankers.
Mhm.
Not because they had a lot of money, but because they knew other people's secrets. Banking is a business which relies on trust, which relies on being a little bit of prescient in predicting early warning signals and advising clients and advising yourself. Now, some of it, because at the end of it, commercial banking is also profit making. So I completely agree with you that 80% of banking has to be continuous, ever evolving, on autopilot, improving. As they say, small improvements like Kaizen has to happen. But because banks have this inherent conflict or moral hazard, that in good times they believe good times will come, and this twin balance sheet, the transfer comes, there has to be an external factor like the regulation, like the policy making. And like, for example, income recognition, that after a particular amount of time has elapsed, that is Indian method. Indian method of income recognition is rule-based, whereas in many of the developed countries, it is judgment-based. That is, even if a loan is even 1 month old, many times when I was in London or when I was in the US, the auditors will tell that, look, this account is likely to go under. The promoters are gambling away the money. The industry has come under a stress. So right in the first quarter, we were asked to provide fully.
Mm.
So, and in India, as I was telling, when I was a young officer, we used to carry bad loans for 4 years, 5 years, like that. So it required some amount of reform to enforce rules.
Yeah.
So reform externally imposed and reform driven by the inherent demands of business, both must coexist. That is my view.
Thank you, Harish. Thank you, Harish, for a very good question. Thank you, sir. While we wait for the next question to come through, sir, we look at the PM's vision. PM's vision of a $5 trillion economy by 2024. Of course, this he said BC, before COVID. That's his target. He's put a target in front of everyone that let's go for it, and it's possible. This will require, to achieve that, this will not require just reforms. I think it will require sweeping reforms and changes that need to come across all industries, not only banking. What could be some of those sweeping changes, sir?
Okay, I think if we look at what has been done so far, it would be foolish to be dismissive about what has been achieved so far.
Yeah.
If we look at cell companies preempting credit, 3.8 lakh cell companies have been delisted in the first phase of legal reforms after 2016 or 17, which is no mean achievement, because where exactly the bank's money was going, and whether there are 2-tier structures, 3-tier structures, whether when we were middle-level officer, when I was general manager, that time, whenever we used to go to North Block, the joint secretaries there used to say that we are determined to stop treaty shopping.
Mm-hmm.
There were companies in Mauritius, there were companies in Virgin Islands, British Virgin Islands, there were companies in Singapore. Now, but the simplification of taxation, tax reforms is another important thing that has been done. The other thing is that, both I I often mention it. I do not know whether you have heard it. I think I told it in the Institute of Chartered Accountant India's webinar. The banks are feeling a little bereft of peace because of two things. One, the two quality assurers or external validations that is there for the banking system, namely the accountants and the rating agencies. Both have been proven to time and again fail the bankers and the general public.
Mhm.
What we have found in case of a DHFL or in case of a the many other things is that you have a AAA company which gets downgraded to D in a period of 30 to 45 days. So
Yeah.
the external validation of the credit worthiness, which is one of the pillars of the stability of the financial system,
Yeah.
is somewhere getting compromised, either because of lack of data, lack of competence, or compromise of integrity. So for that, regulation has been brought, what should be their board composition, what is the independence, and whether also it has not been implemented, whether the companies themselves will pay for their own credit rating. Similarly, accountants, most of the financial statements on which banks relied were prepared by the chartered accountant community, which were later on found to be fraudulent. Now, again, the same community is being appointed to conduct forensic audits.
Mm.
So we will have to have these regulations, and banks have a formal regulator. Now, it may be a very inhospitable thing if I mention that there should be beyond self-regulation. There is like judges appointing judges under the collegium system. The Chartered Accountant Institute of India regulate the chartered accountants. So we will have to move from there. Of course, IBC has come, the GST data being available to everybody, PAN data being available to everybody, RBI's oversight on cooperative banks and housing finance banks. All these things have been achieved. So, as you rightly told, we will have to look at, comprehensive reforms, not just, not just creating a bad bank. As I told, shadow banks,
Yeah.
the NBFCs, they are also creating a lot of value addition in the rural and last mile delivery ecosystem. How do we reform them? Those are also important. Labor reforms.
Yes.
So reporting reforms. So all these information, transparency, everything, if banks become very transparent, but corporates remain non-transparent, and they are hand in glove with their accountant or with their rating agency, then everything comes to a naught.
Absolutely. I think I agree with you, sir. I think when we talk of reforms to reach any target of 5 trillion, it cannot only be banks. We focus too much on banks reforms. It has to also be on the supply chain of our industries. If you look at, the textile itself, the raw material is produced from the west, the yarn is from the north, finishing in the south. Such a lot of cost that is going up into this. I think we need to look at some of these that also happens in chemicals and other industries. So moving along, I have a question coming to you, sir, from Mr. Prabhakar Kaza. I'm sure you know him. He was also one of the speaker. Both of you, I guess, were in London. So he says, why do you think there are huge corporate frauds occurring in India in the 21st century? Is it due to the unprofessional assessment, lack of oversight, inspections, or political hierarchical interference? Don't you think, like in the good old days, RBI, some other organizations scrutinize proposals after approval and express their opinion on large loans? The present situation, according to him, is far from satisfactory. Sir, your thoughts?
No, I think greed and fear has been fundamental to human and corporate existence. Frauds do occur, irrespective of in hindsight, every sight is 2020. I think the bars have been moved. What went as normal when we were credit officers, what went as normal is now probably considered as a fraud. And many of the frauds that we are declaring today, based on retrospective forensic audit, went through just like that. Diversion. For example, many times when as CEO, I used to interact with the RBI governor. RBI governor, one common refrain used to be that the frauds in the banking sector has gone up by 200%, 300%, or 400%.
Mm-hmm.
Now, let us say that without naming any company, let us say there is a company, ABC company.
Yeah.
The ABC company is thinking of starting a new venture. So it acquires land, it gives advances for machinery, it recruits people, it sets up a camp office, all those things, and also spends money for development, etc. All those things he diverts from the available cash. Now, if the old company also goes well and the new venture succeeds, then everything is okay.
Yes.
Nothing is raised. But the moment the new company doesn't get a license, the money gets stuck permanently, and the old company, because of the industry cycle, also gets into a problem, then diversion of funds is a fraud. So you declare the old company as fraud. So diversion of funds and, which were normal practice. I do not know whether, private equity players and venture capitalists, because bankers today are rolled into one. They are venture capitalists with limited upside and unlimited downside. They fund infrastructure with essentially a short-term kind of a balance sheet. So some of the frauds, as we are seeing, is not unique to India, but because of definition and technical things, they are frauds. And I think this is an evolving kind of an economy, and the frauds that were perpetrated in developed market, we only trust that those things will stay away from our own market.
Right, sir. Thank you. Thank you, Mr. Kaza. Good to have you here. The next query is coming to you from the media, Mr. Krishna Tripathi, who's been a regular listener to this. Mr. Tripathi, please unmute and ask a question.
Good noon, sir. Krishna Tripathi from ATV Bharat. Sir, RBI governor has reignited the debate on a separate resolution corporation. Sir, what are your views on it, and whether banking companies can be resolved through IBC? What are your views on it?
See, what has happened is that initially when IBC was enacted in 2016, even NBFCs were not within the purview of IBCs. But later on, with the concurrence of RBI and seeing that NBFCs are in stress in big number, they have included now in IBC. Because who are the creditors of the bank? The main thing is that in case of a manufacturing company, there are operational creditors and there are, secured creditors. So the two class of creditors, you can deal with them. Now, in case of a bank, if a bank goes into liquidation or bank goes into IBC, its creditors are millions of depositors. So how do you take them together? And if you take one group of, depositors as representative of the entire, entire segment, then there will be so many complaints. So the practical difficulties of resolving a bank stress through IBC in the current framework is probably is a little difficult. But yes, there could be a separate, what I have seen abroad is that, there essentially what happens is that they are put under the equivalent of a PCA, whatever was done in PCA, but a privately monitored new ownership. And new ownership has a backstop kind of a mechanism where they can also exit and they can fail instead of having an engineered kind of a rescue act. It should be that they should come one by one. Each conditionality is getting satisfied, they will stay or they will exit. And the equity will first go into how HQLAs will be, what they call is that the living will, what is drafted when the bank is doing well. And living well is a document in trust, which has the approval of the regulator, which has this thing, and those kind of high quality liquid assets. Because most of the frauds and most of the reforms are required in the treasury itself. Because some of the biggest problems that has happened in banks is not in lending. It has happened because of the treasury operations and the exotic instruments that treasury dealers manufacture and they sell it. It's not because some loan has gone bad and that is why the bank has come down and under. So reforms required in monitoring treasury. Treasury is now, most of the banks is kind of a holy cow. So we need to look into those areas also.
Sir, some people also question the strategy of merging a weak bank or failed bank with a strong bank, because they say it will compromise the balance sheet of the stronger bank. So do you recommend the yes bank model where the bank has to be revived separately by keeping it a separate entity?
No, yes bank and the merger what we are talking in fact Arvind Subramaniam in his book Of Counsel, he writes that it is the worst possible idea, and also Raghuram Rajan tells it, and also all Y.V. Reddy and others, they tell that merging an unreformed bank with another unreformed bank to create a bigger unreformed bank is probably a band-aid solution. That is what that is the word of Arvind Subramaniam. That probably in a bigger vessel, the leakage will not be noticed. Drop by drop, the leakage will not be noticed. In a smaller vessel, it is a relative phenomenon. So that is what he tells. But Yes Bank is a different. Yes Bank is a rescue act. In fact, this again shows that privatization may not be the panacea. If we look one after another, private sector, most of the last bank in public sector that needed to be rescued was probably New Bank of India, which was long back. After that, all the mergers that has happened or all the rescue acts that has happened, and currently whatever is in the pipeline, including Lakshmi Vilas Bank or whatever bank that we are talking, are all in the private sector. So private sector, yes, it brings professionalism. It gives RBI more power to get hold of them because of the dual regulation in case of public sector banks. Many times RBI has expressed that they are not having adequate power to control public sector banks. But fact remains that privatization cannot be a panacea. It has to be modulated with proper reforms. As I told, treasury reforms, reporting reforms, other sector reforms, those are required.
Thank you. Thank you, Mr. Tripathi. Thank you, sir. Sir, we have passed the hour. Are you okay for a 2-3 minutes extension?
Yeah, no problems.
Okay, sir. So I have, based on what you said about privatization, question is that is it necessary, to bring also the much needed reforms and the change in the way we want to look at the banks? Is it necessary that a banker should be a chairman? The example is PJ Naik. He was not a banker, but a bureaucrat. He did pretty well. What's your view?
No, for that matter, even, today, companies like IBM or some of the companies, they do not have technocrats.
Yes.
Who have no knowledge of technology. Absolutely, they were never software engineers, or
yes.
Airlines are being managed by non-airline personnel. And, so theoretically speaking, it is not required.
Yeah.
Because two things happen. One is that you must be lucky to be the right person at the right time to change it. And second is that, there are always people skills, because at the second level, if your manpower is very strong, very good, are willing to support, and you can bring their loyalty, then it is good. Yeah, but at the same time, today, as I told you, whoever are the policy makers, practical banking experience is very much required. If we look at ease or whatever, yes, commonsensically speaking, or nobody can quarrel in terms of telling that yes, technology is required.
Yeah.
It is not what, but as I always say, where, how, and how much. That is important, and that requires professional banking experience. And banking is becoming very, very complex and very, very, multi-dimensional and multimodal. So while it is not necessary that
yes.
The chairman or the CEO should be a banker, but at the same time, it is necessary that the second line at least must have experienced bankers, or
yes.
the government's policy making advice. As I told, not just this webinar, but many other webinars when I prepare, there is so much of shortage of good experience and good papers from experienced commercial bankers. Yeah. In fact, the 5-6 books that I referred are all, I'll show you. I read Arvind Subramanian, of counsel, he was chief economic advisor, so a professional economist. Then, backstage, again, Montexi Kaulawalia, he's also a professional economist. Then Y.V. Reddy, again, advice and dissent. He writes about, banking sector reforms. He's an IS officer who took interest, he's an economic bureaucrat at best. But, banking sector reforms, yes, and similarly, if you look at the other book, which deals with who moved my interest rate. This is by Dugri Subbarao.
Yeah.
He also, we are all educated, and the closest that could I see to a practitioner is, Edward Thorpe writing about a man for all markets. This is an interesting book. He's a private equity player who took stake in various, various banks, and failing banks, and brought them up. So that is the latest, that is the closest that I could get to a practicing banker's perspective about banking sector reforms. Otherwise, it is all, as they say, primary research and secondary research, they have their own values, but primary research is primary.
Yeah, thank you. So one question from Mr. Vijay Kannan, ex-chairman of IBA. I'm sure you know him. In a scenario where liabilities of the bank are predominantly fixed, does it make sense to have only the assets linked to external benchmark, not related to banks' cost of funds? How will it affect the profitability of banks which are already under tremendous stress?
No, we are making a lot of efforts to link even in fact, I think SBI has done it. I have also done it in Syndicate Bank, where, external benchmark linked deposit rates we introduced, that so that at least part of the balance sheet gets repriced in the liability side along with the asset side. Otherwise, it is rightly told that but the Indian banking, as I told, I agree with Raghuram Rajan that it is a different banking. A lot of people, for want of equivalent of 401k or any kind of a good pension fund, depend on bank's interest rate. And government's substitute of it, what they call it, in a post office old age pension, or it is limited to 10 or 15 lakhs, which gives you a monthly interest of 8 or 10,000, which probably will be inadequate for most of the people. So interest rate reduction has also a social pushback.
Yes.
So that social pushback needs to be managed, because at the end of it, banks play in a society. So I completely agree with you, sir, that the bank's profitability will remain a unsolved kind of a puzzle, and banks have to keep on trying at getting it right.
Thank you. So my final question to you before we end, it's just give me briefly. So the challenges faced by banks in a developed country and emerging economies are different. Can you highlight the major differences in banking reform agenda, namely the emerging economies? Just one example of how we should treat this differently.
I think I'll put just 2 or 3 thoughts in your mind rather than answering.
Yeah. Okay. Sure.
One is that what are the hallmarks of a good global bank? A good global bank has a good trade finance and fundraising program.
Yeah.
A good global bank has good communication systems to securely transmit, because when it is present in many global areas, so it requires that the communication should be secure. What in part SWIFT does, and now after the sanction regime has come, alternate messaging systems have come both in China as well as in Russia. So these are trying to come to the fore. The third thing that is required is that what in India today, 3 banks, SBI, HDFC Bank, and ICICI Bank, have been asked. They have been classified as TBTF, or too big to fail. So because there will be too much of systemic chaos if that is done. So what they are doing is that they are asking, the regulators are asking these banks to provide additional top-up capital, to hold additional top-up capital. So these things can be managed. Now, if we look at Western practices, the Dodd-Frank Act, which was the beginning, and which has its reflection in Europe, the responses or the results have been totally different.
Yeah.
The European banking system is still limping, and limping badly. The Deutsche Bank of the world, or many of the names I can take, the regulation got tighter, the economies got slower, and Brexit has not helped. And there is again, there is large demand in sections I read yesterday in Project Syndicate as well as in Economist, that there are demands in Italy even to come out of the European Union. Now, European Union has only, only kind of a moral power. It doesn't have sovereign power to put somebody. So the response of the Western economies, especially in US, UK, and Europe, have been entirely different to reform. But the regulators are going head over heel to enforce additional capital, quality of capital, and the application of capital at the time of problems. So this is one thing that we are seeing. Second thing that we are seeing is that the management of banks, the average tenure of a CEO pre-2000, and there was an interesting paper in which the average tenure of CEOs pre-2008 and post-2008 has been roughly around 45%. That is, earlier if CEOs were in position for 10 years. Now they are only 4.5 years. So if we look at the past trend, that whatever happened in the West is getting reflected with a time lag of 4 to 5 years in India, I think there are clear writing on the wall that the ownership interests which are in conflict with the banking sector must be addressed. The capital is not a panacea. Privatization is not a panacea. We must develop our model and we must keep on experimenting. And that experimentation will only give a model which is fit for us, not based on a few imported economists who will bring imported concepts and try to implement it in India.
Thank you. Thank you, sir. Ladies and gentlemen, we come to another very highly informative and thought-provoking session with Mr. Mahapatra. As usual, he has been very eloquent, very informative. So the Indian banking requires, as he said, structural transformation and innovative agenda if it has to play a major role in taking India forward to one of the largest economies in the world. Its failure, ladies and gentlemen, will mean India will fall back, and that's the reality. So, so this topic, what we discussed today, was extremely important. Mr. Mahapatra, thank you very much for coming over, spending more than an hour with us. I'm sorry for the extension of the time. We look forward to meeting you again in some other programs. Thank you very much.
Thank you.
Thank you. Have a good day.